Good morning, traders. Welcome to the Traders Lab. I'm your host, Tom B. Appreciate you stopping by the lab today. Got a lot to talk about. As you guys might know, there's fundamental inputs. The 90-day tariff hold has been disrupted, so the market is repricing to reflect a new fundamental input, and which created our gap, and the market is doing its thing. So we're going to look at that today. We're going to look at specific trades that are qualified based on structured trades in the Bookmap Discard Trade Lab community. And we're going to take a look at how you might navigate a day like today. Now, I want to remind everybody that there will not be a stream on Monday. Markets are not going to be open here for Memorial Day. So that sets up a scenario for today also of potential short covering, or what's called responsive buying. So walking into today, we have to be aware of potential squeezes. And where does a squeeze come from? It comes from the shorts that are already in the market. It comes from what we had yesterday was some responsive buying. Ultimately, with the market selling off, or at least for me, it was only shorts yesterday. Of course, other traders who trade different time frames can be doing whatever that has a vetted edge. There's not a right or wrong in trading. But I will say the business of trading is all about edge. So it's a gaming business because it's 100% random 100% of the time. And as you know, we had tweets this morning about Apple having a tariff put on their phones. We had input from POTUS about increasing tariffs on the EU. All of these are negative inputs, and that is the reason behind repricing. And that's how the market works. It takes inputs and then auctions them. In other words, what does this mean to the participants? Well, obviously, this is a big change, and the what we had gained from the reprieve is now erased. So we're back to business as previously, and the market is doing its thing. So we're going to take a look at this. And like everything, you have to vet trades. You have to know where your trade might show up. You need to take risk in order to benefit. And you will also take stops because all businesses have overhead and cost of production. And of course, psychologically, we want to run from risk because it's our primal wiring. But in the business of trading, it's only by taking intelligent risk that you create the opportunity for net gain with a vetted, structured trade plan that has an edge. General disclosure, all Bookmap Limited materials, information, and presentations are for educational purposes only and should not be considered specific investment advice or recommendations. Risk disclosure, trading futures, equities, and digital currencies involves substantial risk of loss. And is not suitable for all investors. Past performance is not necessarily indicative of future results. Please remember this is not a trade calling room unless we get into real time. And even then, it's not trade calling. It is education only. In addition, there are 60 PDFs of structured trades that are available to everyone in the Bookmap Discard Trade Lab community, as well as a library of webinars that you can access, and there's absolutely no cost to visit the Trader Lab. It is a community of like-minded traders who come together to leverage their collective experience. The idea is the leverage and the mutual support is that we can all do better. I've been in this business going on 46 years, professionally and otherwise, and every day I think about getting better. You will never stop trying to get better if you are committed to a craft. And that's what we're going to talk about, the business of trading and the craft. And I want to thank everybody in the Trader Lab who participates, posts charts, asks questions, and is not hanging out as a passive participant in the background. One of the things that's really important, how do you maximize your yield and the time you invest? It's by participating. And if ego is the reason you don't participate, that is a derivative of needing to be right. Needing to be right cannot exist in trading. Detachment is what exists in trading because you're in a random environment. If you need to be right, or how you appear in a chat or in any forum, then you already are experiencing a psychological impediment. Don't ignore your behavior, because the primal wiring is always at work, whether it's being successful in a trade and then we don't take it, or whether we need to be successful to look good. It's the same thing. Does that make sense? Anyway, welcome to the Trader Lab. If you're interested in these concepts, and they're the same things we've all had to deal with in our development, and many of you, of course, are still dealing with it, and in reality, you'll always have to deal with it, because the primal wiring is never gone. The emotional triggers never disappear. It's how you can desensitize yourself when you're in this environment is what makes the difference. I hope this is valuable to you. Thanks for visiting Trader Lab. These are what the 60 PDFs of structured trades look like. There's order flow phenomena, live trades I've taken over the years, and these were posted just as a general broad brush stroke of what I do. And this is not plug and play. If plug and play worked, we'd all do plug and play, and we'd all have ATMs in the basement, and I'm going to suggest not so much. Now, if it works for you, come to Trader Lab and help us do better. That's the purpose of Trader Lab, to leverage our collective experience so we all do better. It's the power of numbers. Now, this is the higher time frame, and you guys have been seeing this. Now, let's take a look at what's going on here. This was when the auction went bad, the interest rates, and I've been narrating this. I'm not going to spend a lot of time with this, except to let you know what has been on this chart. And I believe this was posted yesterday morning prior to RTH. So we were in this consolidation. The trend was up after the reprieve for the tariff pause, and it left a huge gap. And as you guys know, the market tends to return to locations. The trend was up until here. Then we had an inside day, which is a balanced day. We were trading up to here, which is our retail price, the yellow line. And then we had our up day, and we were targeting that yellow line. And then the news hit, and that changed the auction. Trend day down, everybody running for the exit. And where was our target coming down? 55, 54.50. And that was our target. Now, there's no precision in the auction. When this happened, the uptrend is over. Now, who's vulnerable? All the longs that are in this leg. That's called fuel. The fuel is under here. That sets up filling the gap and eventually, potentially coming down lower. I hope that makes sense. Now, there's a little more, right? There's always a little more. This is yesterday. Now, you already saw, the gap is here. This is the trend, the tariff pause, the 90-day, yeah, right, and inside. Now, why did we have an inside day yesterday? Let me give you some ideas. Very simple. In fact, it's so simple, you wonder why, some things are very, if you've been doing this a while, you understand the market rotates. It does it in all time frames and fractals. Let's look at how it works. The market goes down to go up. What does it do? It squeezes the shorts in the down leg. The market goes up, and it then came down. But we have a big up leg. What does the market do? The market comes down, cannot take the stops, and goes up. This is very bullish here, right? The market goes up, so it goes down to go up. It goes up, takes the stops out above this high, makes a higher high, and then what happens here? The market goes down, it takes all these stops out, so it can go up. The market goes up to go down. The market goes down to go up, takes the stops out. The market goes up to go down. The market goes down to go up. The market goes up to go down, take the inventory, the stops out. You see the pattern? The market goes up, and then market goes up to take the shorts out. The market takes the shorts out. What does the market do? The market goes down, right? Then we get the news, we get the gap. Market goes up, takes out the stops, goes down and up. Market goes up, takes out the stops, any shorts, market goes down. Market goes down, takes out the stops, and this is the high of the move. Thanks for playing. We send you a coupon to the buffet. Inside day, jump out the window. Now, this is yesterday. What do? Market checks the previous trend day low, and then we get something called responsive buying. Responsive buying is the weak side, but think of it this way. The market goes down, and then it goes up. Why does it squeeze? Because the shorts are sitting in here. Then what do? News, gap, whatever. And then what does the market do? The market goes up because the shorts in this leg are going to take profits potentially ahead of the long weekend. Would you stay short over the weekend or would you run to the ATM? Think about it. Now let's go a little further and then we'll get into. Now, this is a Renko chart and I use it primarily so I don't lose, you might say, it's called the forest in the trees, if you've heard that statement. Now, yesterday, I have to talk to you about yesterday because this is, well, let me start out. This is the trend day down, the RTH, and these are ETH. Yesterday's RTH, today's ETH, and this is what's important. This is called a low volume node. And in the trend day, the final auction was this rotation. Now, we start with the ETH. Continuation, so selling at the end, and then of the RTH, trend day, and then rotation up to where? Outside edge of this auction or distribution of volume. And the reason there's this low volume node, and that's what it's called, is because the sellers are going, I'm not paying that. But the buyers, the short covering was happening here. So when we open, we get more short covering from the shorts in the trend day. Now, where does that bring us? During the ETH high is there, overnight high. So what happens then in the ETH? I'm not paying that because they wouldn't pay it there. Down we go. Now what? In this leg, the market is short. And then we get our short covering, ETH low. Okay? We come up. Now watch. We get selling first thing, yesterday's RTH, and then the shorts in this leg and over here with the stops above the ETH high. Now I'm RTH open. Market is short. Get shorts at the RTH open. Those shorts become buyers. Remember, the market goes down to go up. 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 Now, where's my stops? They're sitting here at the ETH high. So now let's talk about yesterday. Now, in this configuration, in a trend down, for me, and I'm not saying this is right, everybody does their thing, there are traders in Trader Lab that are going to be getting long to squeeze. And then there's other traders like me, and I'm not saying this is a good plan, it's just my plan, that I'm going to be doing something called mean reversion. And what mean reversion is if I get the squeezes going, which is taking these guys out and some of these guys, only trade I have is selling to the mean, and it's called mean reversion. So I come up, I squeeze these shorts out, I take another short to come back to the mean. I come up here, what am I doing? I'm taking shorts to the mean. So all I'm doing is selling. That's me, not saying it's good. Other traders in Trader Lab are going to be buying. There's no right or wrong. Now, this is the ETH, and we get the news, all right? And it's like, what's happening? Okay? So now, and we come down here. Overnight volume point of control is the same process is this, potentially mean reversion. So initially, the low volume node of this distribution in the ETH is right up here. You can see the low volume drops off. It's the same as that. Okay? So what am I doing? Well, good question. So I'm looking in this area to come back here. So initially, I'm doing the same thing. Why would I do it? Trend is down in the higher time frame. The other part of it is, how do I get aligned? I'm not going to sell this. I have to, and what's going to happen here? Market goes up to go down, goes up to go down. Market goes whatever to go down, goes up to go down, goes up to go down, goes up to go wherever. ETH goes, and now we go to RTH, potentially up to go down. So that's the lay of the land. And we also have the possibility in these conditions to come back to the ETH, the mid ETH, the full session VWAP, LVN, and maybe fill the gap. Who knows? Not our job to know, because we can't. By the way, if you have questions, please post them. I'll do my best. I can't see the questions while I'm discussing this. They're on different computers and different monitors. How are you guys doing? Hope you're getting something out of this. And of course, welcome to the Trader Lab. And if you're interested, use the link in the bottom of YouTube if you want to download the 60 PDFs of structured trades and access the library and the Trader Lab community. But you do have to verify your Discord email so we can confirm you're not spam in order to keep the community pristine as possible. So this is still the ETH, okay? So now let's get into RTH open. Let's see if we can do this without trouble. Let me see what I got going on here. Oh, wait, I got to turn some levels off, guys. One moment. As you guys know, I export levels. It's called Cloud Notes from my Investor RT. It's very cool. They end up in here in the Cloud Note column. I also export levels, low volume nodes and high volume nodes off Investor RT. And I've been using Investor RT, I don't know, 2007. I don't even remember, maybe earlier. Previous to that, it was CQG. But Investor RT it might be the premier tool for volume profile analysis. Anyway, so let's look. We're coming into the RTH open. We are in the open, and what do we anticipate? Now, what do we anticipate? What does the market do in front of a long holiday? What would you do if you were short and you got this gap? Might you cover and take a profit? Yeah? Question. So we have to anticipate trades. We can't predict anything. At least I can't. Maybe you can. I'm not in the prediction business. I'm in the alignment business. Now I'm going to take you into the open. And I'm looking for shorts. Why? The trend. Now, this is just the way I operate. There's other traders in Trader Lab who are going to get long and trade what's called the responsive side. I don't do that. Why? Too much trouble. And there's another reason for this. If you keep statistics, and it's very important to understand what your edge is and where it lies. For me, even though I can trade the counter, what I perceive to be the weak side, I know that responsive buying, remember, the market goes up to go down and the market goes down to go up. Why? Because there's fuel always on both sides of the market, and the fuels represent stops. So I can get buying, but is it initiative buying or is it responsive buying? Is it a short squeeze or is it a initiative trade? In other words, somebody who's actually moving the market because they want to get short or get rid of long inventory. And then when the market runs out of those sellers, it will counter rotate. Market goes down to go up. And the rotations created by the retail, a lot of that rotation is us. with the buy stops who are trailing. They become buyers. Is that logical? Let me know what you think of that concept. Just throw something in there. The red and green dots, is that, what was that? Oh yeah, the red and green dots, Eric, those are delta. And remember what delta is. Delta is aggressors, and we don't know what an aggressor is, market orders. And what I mean by that is buy stops are market orders. So delta represents stops and initiators. So you don't know what's going on as far as the delta. What's important about delta is the reaction. So there's always, there's the limit, the passive side, the limit order book, which is liquidity, and you can't see them. Now, when icebergs, because orders are tagged, icebergs, we can see the icebergs, we can see the stops, and the market orders we don't see, but we see them as delta. So I hope that answers your question. Now, the important thing about delta is what happens with it. Because right here, there's buyers, that's the stops. This is a stop and iceberg detector. It gives you more insight. And sweeps, that's another thing. We'll talk about that. If I see the sellers here and I see the buyers here, but I see the icebergs, I know, and they're passive. These are limit orders. That buyer is being absorbed. I hope that makes sense. One moment. Okay. Sorry about that, guys. I was getting some input from Bookmap. Okay. And it's regarding the drawing tools we've been talking about, and they will be coming out. I've been just told in a future, it's being worked on, okay? But it has to do with it's a little more complicated because of the interface and the graphic interface. Anyway, this is liquidity resting in the book. Now, here's something, and I call this VPOC migration. Now, remember, I'm anticipating responsive buying. So I need to be patient because the shorts, I'm looking for the shorts to cover. Now, the problem, of course, with everything is trading. Where's that stop, And initially, I'm looking for this. And it doesn't mean we won't get here later in the session. In fact, it's a target. But that's not the point. Nobody can predict anything. So I'm not in the prediction business. I'm in the business of maybe. This is called VPOC migration. And I came up with this because years ago, I had observed behavior and I researched the heck out of everything. And early on, I learned market profile from the guy who created it, Peter Steinmeier. And then I went in a chat room with market profile traders. This is way, way back when there was early chat rooms. There was no I can't remember what it was called. I just don't remember. This is called a variable high volume node. And I saw a phenomena and I started posting about it. Hey guys, what about this? I think, because I'm a research lunatic, I'm always curious about phenomena. And most of the time, maybe 95% of the time, my curiosity gets thrown in the round file because I see patterns of behavior, and we all do, and we think it means something. Well, patterns are fine, but if they don't have a statistical edge, then it's just garbage. And most of retail traders initially see a pattern and they start trading it. But if it doesn't have an edge, it's a guarantee. And I'm going to use the word guaranteed where there is no guarantee in this business. But that's a guaranteed loser because if it doesn't have an edge, the dollars are going to flow to the other side, even though it has random winnings. So the random winnings keep us doing it. But over time, if it doesn't have an edge, you might as well just write the check out now and not trade it. You hear what I'm saying here? That's the truth of the business. VPOC migration means that the current condition is accepting higher prices. So this keeps me from getting short. So I'm here and I'm just waiting because I'm still looking for this. This is the retail price from the ETH. The market tends to go up to go down. So for me, I'm only going to looking for short. So let's go take a look. VPOC migration going higher, Lewis. I'm just sitting here. So now I have that low volume node from the ETH. And this is the, let me just get my brain screwed on here. One moment. 5805 was the ETH. I got to go back here and show you, I mean, the value of the Trader Lab, 5805, I believe, is here. Yeah. This is that LVN. So my first area to look for a short, remember, was there. Why? I'm not paying that. Oh, but it's on sale, retail. So this is the first trade for me. And whatever happens, happens. You know what they say, what happens in Vegas stays in Vegas. So there's my location, okay? So now I'm looking for a short. Let's see. So what do I need to happen? I need liquidity, I need absorption, and I need a trigger. This is my first trigger, and it's at a location here. I'm going to put a little box around it. Now, I do this. I always want to tell you why I do this. I put the box so you could see how order flow might impact what we're trying to do here. And the result of participant behavior is price action. This is a short entry. This is a trigger. Where is it? It's in alignment with that. I'm not paying that from the ETH, okay? Full session VWAP, I think, maybe. Yes, was right there. Another area. And now here's, and this is the entry. And you got to vet these, not a recommendation. Stop goes here, okay? Now your job, if you get short here, is to get risk neutral. This is called VPOC migration. 1 second. Let me make sure. Okay. So the VPOC migration is telling me that this distribution at the moment, where that is too low. So the auction is telling me that pricing is moving higher. And I know, and when I say I know, I suspect, but based on my understanding of market mechanics, that these guys are profit takers. They're not the strong side. They're the weak side. So I want to be fading them because this is called mean reversion. Now, this right here can be a problem. This would be my target if this is too high. The key piece in this is if I get short here and this shifts up, the teeth will chatter. And my micro high volume structure, I'm taking you a little deeper. This, let's look at what this is. This is the auction. And what the auction is two sides. Now, as we go up in time frame, as you think of it, this is the same behavior. Okay, this is fractal. And in this auction, too high, too low, too high, too low, retail, this is too low. When I come up here, it's the same, but it's there. The retail price now is there. Too high, too low, too high, too low, retail. If this price becomes too high and I leave it, the shoppers are not willing to pay the retail price. Get out of here. And what's it in alignment with? Where the ETH shoppers said, get out of here. Short, one tick below here. Now, this is, you got to vet this. I'm only giving you structure. It can also return here, and it's mean reversion. What is mean reversion? Return to the high volume. What is reversion in a fractal? Potentially return to the high volume. And when this shifts up, the problem, and I'm going to tell you the problem, if this is too low, which it might be, is this too high? So if it shifts, it can do that, and I get those tire tracks that we all like, or it can reject this and come here. Let's look. First trade. To where? Here. See the behavior? So this is a structured trade if it's your thing, right? I'm not saying it should be anybody's thing, but right here, so the short is there, the target is there. This is, and this is another little piece right here. I forgot to mark this. Let me show you this. So order flow, the liquidity are all pieces. And with Bookmap, you can see this stuff. Let me try to get this extended. It'll be nice when we actually get these to extend on their own. So this is the primary target back here. Remember, too high, what was too low? This, and you got this. Another little item. Where's resistance? It's now here. That distribution. Now, think of this like vertical integration of time frames. I hope this makes some sense. So if this is the high price, and in the fractal, this is the high price, I'm not paying that. I'm really not paying that. Oh, that's kind of undervalued. Where do we come back? There, there. What is this setup? Well, right here, it's a question. Are we going to take this out, which is the low price, and continue to this one? Or are we going to come across? And that is, as they say, the $64,000 question. Let's watch. What we know is there's shorts here, buy stops, I mean, and we know there's sell stops under here. If I come outside, and we had a report at 9 a.m., I think it was housing of some kind, and I come back here. Let's look at this trade. Now, and this is also a structured trade. I come back to where? The high volume. I get a buy sweep. This sets up a short. The trigger is right there. There's the test, same structure, and the target is to come down here and then potentially come out the bottom. That's the trade. You would get short, and you would probably, unless you got scaled, and I can't tell you if you'd get scaled or not. By the way, the entry is here because this is where the buyers were, the sweep, and the sellers took over there. That's a Trader Lab trigger. The entry is there. The stop is up there. I'm not going to draw it. I already showed you the first one. You can kind of extrapolate. And this is a mean reversion trade. So subject to how you manage your trade, you would be risk neutral and you'd scratch, or if you're not risk neutral, you would take a stop. It's your plan, not mine. Okay? Now, I understand something, and I have to tell you what I understand. I'm going to give you another little piece. And I got to thank Rod, one of our Trader Lab participants, for contributing some data mining. And it is that if we take the first half hour's high out, there's a high probability, I won't give you the statistics, these are available in Trader Lab, that we're going to take the first hour's high out. If I understand that, then if I take any shorts, I am excessively cautious. However, and I'm also making higher, the swings are moving higher. But that doesn't stop me from selling. It just puts me on alert that this can be trouble. No problem with the trouble. I just follow my plan. So what do we see? And I posted this in TraderLab. I'm going to draw a little box. This is kind of how and I draw the boxes because as stuff moves off the screen, I'm going to forget that it's material. And I hope that's why I do. And there's drawing tools in Bookmap to help with this. This is a short. Stop is here. This is the target, mean reversion. You notice this trade is the same trade. It just didn't quite get here. I'm taking the same trade, except this time, there's a little bit different. This time I have the same sweep, okay, that wherever it was, I have the same structure. I have absorption up here. There's my icebergs, and I have liquidity. This is now support. I'm above it. Now, and there's my sweep. This is part of the MBO package, you know, the icebergs, the stops. So who was asking me about bubbles? By delta, who are the buyers? The buy stops. And maybe somebody who knows, right? But this is important. Let's look at it now. Break low. Trigger. High volume. Where is it? It's there. Right there. This is my little VPOC, or the mean. If I break down from here, 10 is resistance. My buyers are here. We break below this buyer. This is the first hint. Sellers are below the buyer. These guys were possibly absorbed. I get my buyers here. No bueno. Buyers are here. You can see the delta. Come on. Break. Support. Location. Entry. Target. Okay, that's a structured trade. Now, I don't know if you want to bother with that, but I'm just telling you, I'm okay with this. Are you? And this is just trading the rotations, you know, but 10-point rotations. So are you guys tracking? How we doing? Is this useful? Thanks, introductions. I still like that name. So this is all mean reversion trading. And remember, and I post all this in TraderLab, at 9:30 Central Time is the first hour, and this becomes the IB. And there's over a 90% probability to take out either the first hour high or low. And in this configuration, I'm still looking for it to take out the low. Now, looking for it doesn't mean predicting. It just means structurally. So let's watch. And again, so right here, I've got the IB. And I have over 90% probability in Rod's data mining, which also suggests this may come out. And past performance, not indicative future results. Now, this was very interesting. 9:30, the IB is locked in, and we ended up with something, and most of you, unless you understand market profile, will not know what this is. This is a structured trade for me, I would suggest, or at least suspect most traders in TraderLab don't know about this. So this is not a typical structured trade, but it's a short for me. It's called a one-tick failed auction. And I have alignment with some other levels. Let me see if I can find this for you. I don't know if I can. Let me just see. 15. This is it. This is the outside edge that was too low, and we had our up leg. If I break into the gap, I can come back up here and check this level because it was support. And you know the old saying, support can become resistance. This level is on my chart. I was wondering where it came from. And there it is. Everybody tracking? So I know where too high, where too low was, and it was previously too high. Support resistance. Who knows? By the way, I'm always going to say, I don't know. Here's what I know. I know 90% probability, and with Roddstat, it's still on the hit parade. I also know responsive buying getting out of Dodge because of the holiday on Monday here in the U.S. Buy sweep, liquidity, break, pullback to the IB. This is a advanced structured trade in the Trader Lab, and I understand most traders wouldn't have this trade in their arsenal. The high volume, let me bring you back. And I know this might be meticulous, and you might go, come on, I get it. Is there? Let's look at this. Now, when you have high volume, think of it like a retail price in a store, because that's how I visualize this. In other words, when I was trying to relate trading to something I understood, I understand shopping. So do you guys. If I find a price that's too high somewhere, and I fulfill a statistic somewhere, and I have a level somewhere, I'm then very attentive. And I have this liquidity, and what's happening up here? Absorption. And this is the absorption. Buyers, down leg. So, but I can't take a short because of the statistic. I want you to understand why I'm sitting here and now I'm not shorting it. VPOC migration. In the developing time frame, we're moving higher. So this creates conflict. It does. Let me label this thing. So what I do is I label stuff so I don't forget it. And that's really important. And now the market, I don't use indicators. So what I learned or taught myself over, unfortunately, too many years, because I had so much junk on my chart, indicators, that I didn't have a consistency. I didn't understand gaming. This is many years ago. So I kept trying to fix, get it better. And I also had winning trades. But I also had a lot of conflict. So it was very hard for me to take processes that I'd spent a decade on and start ripping them out. It was like, the concept is, I'll get something out of it. No, what you get out of it if it doesn't work is more of the same. So it took me a while. But I kept doing my research, and then I started plotting and recording my trades to see where the edges were. And I found I couldn't have an edge with variable inputs. I had to have anchored inputs. And the comparison is casinos play the games exactly the same way, right? There's the sweep, there's the location, there's no idea. And then this. There's my entry. Why? Failed auction, no clue, break low, VPOC migration. What does it say? I'm not paying that. This is the retail price up here. If it's too high, after I break below it, you notice over here, it shifted up and I broke high. And we had the stat. Can you see the logic? And over here, and you can't tell a failed auction until it happens. It's like, oh, this is here. Once I break below it, it's too high. This is a Trader Lab structured short if it's in your quiver. And then south of the border. Where does it go? Back. And we're trying to come here, okay? Down to this one. Now, that's a target, by the way. This. Too low. So you have this, too low, rotation back, too high, break low, going for this. Watch. Try to get this over here. It doesn't get there. So you'd be short, you'd have a nice scale, you'd be managing your trade. Now, this is something you guys have to vet. What happened here? So this here, sellers are here, going here, and this is in the book. Now, I see this, and I'm going, sellers are here, buyers are there. Now, I am clueless. Break here. Now, right here, I can come back here. I can bounce off it. And now I know the sellers were overwhelmed here. So where's my support? It's there, right there. And it comes from here. Can you guys kind of see this? There. See, sellers are here. Buyers take control. Trigger. Resistance back here. Buyers are in control. Buyers are in control. Trouble. And then squeeze. That's kind of how I look at this. And the other thing I know is there's shorts here. Okay? So if we have a failed auction and I know the buy stops are here and I find my buyers, I am not running in front of this thing. Where's my last location that's material? It was at 10. And then the next location is going to be here, which is where the failed auction was. And that's my resistance. If I come up here, I'm back in the same scenario. Mean reversion. I'm only trading shorts, not saying it's a good plan. It's the one I got. I gotta, just do my thing. And it's in the time frame I trade. And what I do, and it's just, maybe I'm just lazy. I just try to pick a side that's dominant. I don't want to trade long, short, because I know, unless something changes, which it always can, that the dominant side are the sellers. Where's my potential for better, larger rotations? It's trading with the trend, not against it. Anyway, I'm not saying that's what you should do. I'm just saying that's what I do. Now let's look. What is this? This is an auction. Now, I don't know where the high of anything is, so that's not my thing. I can't do that. Not my skill. The high volume is here. The sweep sets this up. So I'm always looking at sweeps. It's a great tool. What's happening here? 345 buy stops. Thanks for playing. This is when they hand you the coupon to the buffet and your broker sends you a gift basket. This is a trigger. Now, where did the auction change? And look what happened. Buy stops, sell icebergs. Now, there's sell icebergs all over the place. How do you know? You don't know. Well, let's forget about knowing. If you think you need to know, you're in the wrong business. How can you know? If the casinos don't know what's going to happen on any hand, since they don't control the outcome, how can you? So this is my trigger. The buyers were here. The sweep is here. And then I'm looking, and the sellers took over. So now I'm looking for a pullback for the short. Now, 2 ways into this. And this might not be your trade. So the sellers are here, and then I get a pullback. Now let's look over here. Now, the trade, subject to how you have vetted your plan, would be to get short 1 tick under here with a stop over there. And you've got to vet this. And I'm only suggesting that. In fact, you know what? This should be right in here. It doesn't matter. I have buyers here. I have buyers here. And I have absorption. Now, I don't know. Right? Now, this sweep over here suggests the counter rotation. This sweep up here suggests the rotation. So rotation. So when I see this, I'm looking for that. And, somewhere up in here. So let's look at another trigger. And this is a little different. Absorption was here. Sellers are here. So sellers, buyers, break under, short is here. Now, the way you can work this, and this is not a recommendation, this is the outside edge and the high volume is there. If you put this on, this is where your stop ought to be, because the market can rotate up here, outside edge. So I'm just saying is if it doesn't fit your risk reward, there's nothing to do. It's up to you. And where are we trying to come? Back to the VHVN. Back here. And then if we can't get back above this and this, lower. No clue. Let's look. Now what I'm showing you is Matryoshka dolls, trading in fractals. I'm trading inside using a similar process. So if this is the fair price at the time, and this becomes unfair, do you see something consistent? I'm trading mean reversion. This yellow line is the mean. So if I'm taking a short here, I'm coming here. And I can still fall out the bottom. The primary trade is there to there. It's the same trade as there to there. These are all the same trades from different locations. Same trade, there to there, there to there, there to there. Can you guys see something consistent? How are we doing? Okay, let's keep going. Oh, well, let's not keep going. Let's wait. So the last short was this. I am not participating in longs. I am anticipating, remember, responsive buying. I want to trade with the trend. It's not a recommendation. So all I'm doing is waiting for outside. And what I'm looking at is where resistance is, currently is here, and what's my behavior if I come up the resistance. So my next area to observe is going to be this. And these are not recommendations. I take stops. You take stops. Why do we take stops? Risk management and the random distribution of outcomes. That's why you take a stop if you're following a trade plan. Remember, the casinos pay the gamblers. It's called cost of production and overhead. We experience stops like a personal failure. That's ego. Ego does not belong in this business. You need to learn about your triggers, your emotional stimulus, the need to be right, to get approval, all this stuff. It's the same thing that happens in all chat rooms. Chat room participants that do not participate are really experiencing the same manifestation from an emotional point of view. And it's that fear of loss. Well, if you are fearful, think about what fear of approval is. Fear of not looking good. Isn't it the same thing that causes you not to take a trade? Because of the fear of not looking good to yourself. I really hope you guys will think about that, because it is a key piece to being creating sustainability, and most of us are not even aware of it. Remember, the primal wiring is always operating, so we cannot stop. It's primal, so it's work for survival of the species. Avoid risk. Well, that's the same reason you didn't raise your hand in school, because you didn't want to look bad. Do you see a consistent behavior? Give me a yes or a no here. I need to know. See, all of this, we've been practicing these behaviors our whole lives, and they work in the outside world. When you bring those habits and behavioral responses to triggers here, it does not work. We actually have to do the opposite. Now, a lot of traders ask me over the years, how do you manage that? I said, I've learned by using something called an error cost calculator to quantify the results or the consequences, it's called a consequence, of responding to those triggers. The fear, skipping the trades, bailing out of trades, moving the stops to break even when there's no reason to do it, trailing the stop, whatever it is, out of fear, not out of trade plan. And then I started quantifying that. And I always talk to traders about the error cost calculator. It's in the Trader Lab somewhere. And these are all available, all these tools, and there's no cost, and if you're in YouTube visiting, use the link down there. And I quantified it. And based on how I trade, throw $5,000, $10,000 a month or more out the window. And you'll get motivated to do something about it. Most of us don't go through the trouble of actually identifying behaviors. I wrote a check out for the amount I was throwing away, and I put it on my monitor. And I know I've mentioned this many times, but if you're new here, you might not be aware of it. Once I made it tangible, it changed everything for me because it was on my monitor. I wrote a check out. Or you could just put a commode there and take that to your monitor and put $15,000 or $20,000 in there for a month. Now, instead of making a note or ignoring it and going on to the next trade, a lot of traders journal and then never look at it. You got to do the work. If you want to differentiate your outcome from the majority of retail traders who fail, you got to do what they're not doing. It's as simple as that. And if it's too much work and you just want to gamble, it's a choice you make, and that's okay. Because the traders who have an edge are going to extract the dollars from the gamblers. And if you join the gamblers, you shouldn't expect a different outcome. Kind of realistic, don't you think? And this is not to chide you. It's to educate you to what most traders do and why they cannot create sustainability. If your objective is to be in this business and actually create a business, you have to have proof of concept. You need to educate yourself, and you need to not do what everybody else does who fails. It's not complicated. In fact, learning the trade, I think, if you put the time in, is not complicated. What's complicated for us is operating in randomness, and our emotions to avoid risk are continually triggered. So it takes a lot of time, and metrics are the key to getting control over emotional states. If you're just putting trades on randomly, then all you have is fear. That's what you got. And then fear is the driver. If you have statistics, you manage fear. You still feel it. I feel it all the time. I feel everything you feel. The difference is I've trained myself because of the error cost calculator to realize that when I respond to it, it costs me. And by the way, if I do something and break whatever it is, I don't follow my plan and I get paid because every trade, the outcome is random. And some of these things work. My Hyde, I call it Jekyll and Hyde. Hyde is reinforcing the behavior to continue doing that because I'm getting intermittent reinforcement because we all have winning trades, even if there's no edge. I'm feeding the problem. So I had to, when I quantified the result of the problem, in spite of intermittent random winning trades, I stopped doing it, even though I'm stimulated because it was quantified. So if you don't make the effort for proof of concept, then you're really just playing a video game. And sustainability, I think, based on the statistics, will elude you. Does that make sense, everybody? How we doing? How we doing in YouTube, guys? Please give a like if this is resonating with you. By the way, I should be paying attention here. What is this? Too high. Resistance is here. Let's look back here. Now, this might not be your trade, okay? I'm not saying it should be. What happened here? Now, this might not be anything you should be operating in. I'm going to show you a little something. Well, I'm not going to show it to you. It's a little more advanced. It's still mean reversion. This is still outside in trading. I have no longs. Now, a long for me is cover the short. In other words, when I see a trigger and I have a buy trigger, it doesn't mean get long. It means get out of Dodge. So I'm only taking shorts, and I will take stops. Are you okay with taking stops? I am. Not a pleasant experience. It's not my job. This is what I want to show you. I'm getting a lot of lines on here, which I really wish I didn't, but let's look at this liquidity. Let's see if I can isolate. Well, it's a little hard for me to isolate. It's still this is where you're going, by the way. But it's still mean reversion. Do you guys understand what mean reversion is? I mean, you kind of understand the concept of what it is. So there's your short. This is stacking liquidity here. So those are sellers, okay? Those are sellers. Now, this is a bit different than what we talk about here in the stream usually. This is like more advanced because it's an order flow trigger. It comes back in here. And remember what's up here. Too high. I rejected this. So this is my resistance. Assuming, and that's the word, assuming the sellers are going to come back in and defend this. So this is a distribution I left. This comes back up here. And this, now you got to look over here. This is an auction. I'm not paying that up here. Oh yeah, but it's on sale. And it's happening there. So this becomes the outside edge of this. So if this is too high and I break down and I come back to the outside edge and I get this in front. Now let's come down and look at delta. Buyers, 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 less buyers, icebergs, absorption, and liquidity. Again, not necessarily a trade anybody ought to take. Okay? So this might not be your trade. For some traders, it is a structured trade. Mean reversion. So I want to make the point about a trade plan. Because in Trader Lab, my objective in Trader Lab is to help traders understand the business they're in. But every trader finds their groove. Now, what is that groove? Your dance partner. This is dancing with the market. And I don't use indicators. So what I had to do was figure out what's going on. How can I get an edge over other traders who are using indicators? If I can understand what's happening right here, and let's look at the delta down below. Where's my buyers? So there's my buyers. So I got my buyers. What's going on here? I don't know. There's my buyers, less buyers, sellers. See the delta? So this sets up, you could be selling this, and what gets me into it is coming up here. The buyers are here. The buyers are there. The absorption is there. The trigger happens here. Now, if you can trade order flow, you would be in sooner, or this trade doesn't qualify. It doesn't matter. I'm just telling you. And then you're going here. So this might not be your trade. It's okay. Doesn't matter. And that's it. You'll notice what I'm trading is only one trade. It's outside in trading. This also has a name, by the way. I didn't notice this. This is called the IB failure. It is a structured trade in Trader Lab. Now, the IB failure is this. When the market comes up and it comes outside, and we might have had another one back here, I don't recall. This is a structured trade. That I didn't notice. You could be selling this because what you're doing is the market comes up and then it's a mean reversion trade. This is a qualified trade. So I didn't even notice that. And you need a trigger. Now, if you don't have a trigger, then you don't have a way into it. But that's a target, primarily. And then, subject to, it can come across the range. At some point, we might take out the low of the day. No clue. And it's not important. So I'm only doing this. These are my trades. And, whether or not you want to even think about going lower is up to you. Because remember, ahead of the long weekend, we're looking for what's called responsive buying. Now, is it done? There's the question that we have no answer to because it's random. So if you were short, you'd be taking profits. If you were long, you might be using these rotations to get out. That's how I think about it. And I don't know at any time which rotation is what and who's doing what to whom. So that's why I trade structured trades in alignment with what I perceive to be the context. Higher time frame down, today rotational, responsive buying, and maybe new initiators, or maybe not. What did we have yesterday? Responsive buying. What do we got today? Same scenario. And what was I doing yesterday? Shorts. Same plan for today. And it doesn't mean we won't, go wherever. Not my job. This could be our target and the gap. So that's also possible, right? So if I break structure and I come out here further, then I might just wait. Because then if I start fading it in here, it gets a little bit more problematic. Because then you might just get rotations get squeezed. So when I come back out, then I might just hang out in the Barca Lounger. And if you're looking for Rod in the Trader Lab, he's typically in the Barca Lounger. Do you have questions? And please give a like if you're visiting in YouTube. This is the Trader Lab. Also, there's a link down there if you want to visit Trader Lab, and there's no cost for it. But you do have to verify your Discord email to keep the riffraff out. And so you understand the Trader Lab is about the business of trading. It's not romper room. So, it just is not a kiddie location. Now, by the way, if you're a kid, what's a kid? Doesn't matter. What I'm saying is the stuff that you see in a lot of chats, that's not what we're doing in Trader Lab. It's a professional community of traders. Our senior trader has over 50 years. I've got 46 professionally and otherwise. I paid the dues. I've done the same thing you've done. I've been down just about every dead end that I could find, and everything works. That problem is any process gives you winning trades. And here's I think the catch-22. No process gives you winning trades. So, and that's where I came up for myself, Trader Groundhog Day, because I'd see patterns, I'd see trades, I'd see winners, and I'd, incorporate them. Doesn't matter if it's Elliott Wave, Fibonacci, and much, much more. And all of that worked randomly. If you open up your trading toolbox, your higher time frame, there's maybe 100, 200 indicators in there. I've always kind of thought about, why do we have so many indicators? And why do retail traders spend their potential trading career mixing indicators and time frames? They're trying to create consistency, and yet they all have winning trades, is what takes us into Trader Groundhog Day. I coined the phrase for myself, but you keep waking up in the same place, no matter how hard you work. It might not have anything to do with you. It might have to do with your process and not understanding the business you're in. Trying to solve for certainty to avoid your emotional states, your emotional triggers, your fear, and the rest of it is not the answer. In my opinion, might be the answer for you. It hasn't been the answer for me. So what I had to do is figure out what's wrong with what I was doing. And that was because my beliefs were wrong, and I was following beliefs. A lot of those beliefs and what drove me were psychological, looking for certainty to avoid risk. Remember, primal wiring. If you understand gaming, you have to actually embrace risk to get the reward, not avoid it. It's so counterintuitive to what the function of your primal wiring is for survival. Your emotional or primal brain, if you will, that helped us avoid predators is always with you. It's still going to do the same thing. But here, it's going to interrupt your intention and supersede it. Does that make sense? So the only way to get control of it is to have metrics or tangible statistic. That's what the trade plan is. And that's why if you're not a successful trader, now how do you define successful? It's not random winning trades. Gamblers have winning hands. It is edge. Just think about how casinos operate. No matter what the outcome is of the last hand, they just deal the next one, because the only way they get their profits out is by leaning on their statistical edge, and they accept they're in a 100% random environment. Can you accept that? So the business model is a casino. And then it's up to you to choose what side of the table you want to sit on. You want to sit with the gamblers, which is probably where most of you are right now, or do you want to change sides and sit with the casino and still have to pay the gamblers? But remember, over time, the gamblers are paying the casino, and the casino will give them the cocktails and the ticket to the buffet, and make a substantial profit with that business plan. So we already have a proven business plan. And in TraderLab, the idea is that you now vet the games you bring to the table and only execute the games that have a statistical edge. Tell me that's not logical. Does this make sense? By the way, you're all invited to TraderLab. Thank you. Rambo just posted in the TraderLab the error cost calculator that I was talking about. I don't remember when I started using it, but it was in very early on, and for me it was $10,000, $20,000 a month given away. I will tell you that if you can reduce your errors, you may already be a profitable trader. And then if you can eliminate the trades without edge, you can become, potentially, if you do the work and you vet it, remember everybody has to do their own thing in their own fractal and time frame, right? You can increase that potential profitability and create sustainability. If that's and if you're not doing that, then ask yourself, how can you sustain yourself in this business if you're a gambler? Now, if you come to TraderLab, it's a terrific community. I just want to show you a little bit about it while we're waiting here. I've got nothing here to do, right? So I'm a tourist. But how have I done if I'm taking my structured trades? It's been a substantially profitable day. And it's not over until, as they say, the plump lady sings. This is what the TraderLab community looks like. There's all kinds of stuff going on. Traders are posting their trades, whether they're TraderLab structured trades or their trades. It's the leverage of the community. So this is what's going on. I do a lot of posting in here, a substantial amount of posting. I do not call trades. It doesn't do a thing for you. What I do is point out areas and things to observe, and traders are posting their trades, and there's questions. The whole idea is ask a question. Don't be a lurker. Be a participator. Be brave. If you can't be brave in a chat room, you're not going to be brave in the business. You're going to be fearful. Just look at yourself. Now, this is the library of webinars. Ned takes care of this for us. This is the primer webinar. It's about an hour. It's a high-level overview. I'm an educator, obviously, and I've done it for years and helped many traders. And I just used Bookmap, I think, since 2015. And I posted some things that I was doing think it was on Twitter, I don't remember, and I got overwhelming requests for more. So I started posting in the Trader Lab chat. I'm not Trader Lab, in just the general chat. And then Bookmap asked me if I would do more. So, okay. This is Meet the Trader Lab. This Trader Lab's advanced trading methodology, but I want you to understand advanced doesn't mean complicated. It's actually simple. The problems we have in a random environment is our fear of loss. Advanced trader methodology is ripping out everything and getting down to the fundamental function of the market and how to interpret it and develop trades that give you an edge. So that's what the Trader Lab is. This is just a good example of a day. And it's the same thing you're seeing me do here every day. Just a day in a life. I planned, I saw, I traded. Now this one, stop gambling, start winning. I encourage all of you to watch this. It's a little direct. It might make you uncomfortable because it's frustrating to me to watch traders that have potential throw their opportunity away. And it's a strong reminder of why traders fail. Day trading, why most traders using indicators fail. Now, here's the thing on indicators. If you understand how to do what I'm sharing with you right here, think about what you could do if you added an indicator with an understanding of market mechanics versus just letting the indicator do the heavy lifting and finding out you don't have an edge with variable inputs. Would that change your outcome? Just a thought. Are you trapped in Trader Groundhog Day? Boy, that's my story. And I think it was about 10 years, of trying to figure out why I was having winning trades, but over time, I couldn't sustain it in spite of winning trades, winning weeks, winning months. Because things were pretty much here. Let's watch the behavior here. And use the link in the bottom of YouTube if you're inclined. Download the 60 PDFs of structured trades. What happened here? Liquidity. What might this suggest? You ask. Potential rotation. And then can you get risk neutral before taking a stop? And we all take stops. So, life in the fast lane. So for me, I'm only trading shorts, and I'm going to look at order flow and behavior. So this is very important what happens here. What did I have here? My buyers. Now, either I'm going to get more buyers in here, and they're going to squeeze, or these the absorbers are going to still sell this up here, and then we're going to rotate. And if they don't, there's a stop involved. That's it. Oh, you know what? I forgot to mention something here. I did say it to you, and I forgot, because I don't multitask very well. Coming out above here again would have me off this short, so I would not take this. I'm sorry. Remember I said that. I said, if we come back out, then I have to stand aside, because now there's more squeezing. So no long. If I took this, it would be an error, but I wouldn't take it. But I forgot. So let's see what we get. So I have nothing to do. Now I sit. My next trade, if it sets up, would be a short, but now I have to wait for this, and it would still be mean reversion. But out here, I don't have mean reversion. And this gets very tricky, because now you're going to try to pick the high of something. That I'm not good at that. And believe me, I spent a lot of time trying to read it, because what happens if once we extend out in responsive buying, I don't take the longs, and this thing can go up wherever it goes. It's just not my plan. Other traders in Trader Lab are going to be looking to get long here for the squeeze, you see, but that's responsive buying. I can't say nobody, but initiative buying is not what's in this, in my opinion. It's responsive buying. So what I want to do is get short after the responders come out. They are the weak side. So remember the scenario for today. Sellers, short covering. Sellers, short covering. I'm using the short covering or continuation shorts. Other traders are going to get long here or the squeeze. Either one is right if you have a vetted edge. I don't trade that. I just trade one side. What is it? The KISS rule. I always say I am clueless. And I'm going to tell you why I say that. But I also say I'm not ignorant. I am clueless because I have to have an open mind. I have to be detached from the outcome. So that's part of being clueless. And it allows me to detach and not get fixated on one idea. I just know for me, I have no long. And this could be a trade that goes up 8, 10 points or whatever it does. It's just not my trade. I mean, is that making sense? Now, what do we have? And I pointed this out earlier. First of all, it's shorts only for me. But where's my value area high from yesterday? I mean, we can theoretically fill the gap. We can theoretically get the value area low. And I'm using the term theoretically because why? I'm clueless and I have statistics. But I'm also counter trend. So how do you do this when you have conflict? Me, I stay with the trend. And I take stops and I do everything you do. But my trade plan is reversion trading. But I don't have a short now. My short's going to be down somewhere below. So I have to have proof that this extension is done. I don't have that now. So if I start fading this, I can take a lot of stops now because I'm trading. What's happening here is just counter rotations. And I don't know which one is the right one, right? Well, so I don't trade it. I just go, okay, let somebody else have the fun. And at some point, maybe somewhere in a random environment, it's going to break down and that'll be could be the short of the century. I have to wait for a structured trade. I can tell you right now, if I don't take another trade for the day, it's perfectly fine with me. Are you okay with that? Or do you feel you have to be busy and you are going to be looking because of FOMO? Can you tell the difference? That's what the trade plan's about. Where does your rules or conditional statement process say no more shorts? Or if you have no understanding of context, you'll be fading this, and taking stops until one of them works. And the one that works, if it's not vetted and has an edge, is just random. Because all trades are profitable in a random environment. Does that make some sense? By the way, if you're getting something out of this, please give a like if you're visiting in YouTube. Subscribe to the channel. Yeah, Rob is asking me in Trader Lab. Good question, Rob. For me to change bias to long from short, would price need to get into yesterday's value? My bias is short because that's the higher time frame trend. We had a huge failure. Now we have cleaned out and filled the gap. So all those longs got thrown under the bus. Now, do I want to get long? No, I have no long trades. A long trade for me is to cover the short. I'm aligning with the advancing army. Now, because of the 3-day weekend, and remember, there'll be no stream on Monday for Memorial Day here in the U.S., I just won't have any more trades. It's fine with me, I mean, if you have a profitable day going following your plan and the context changes and we're in I'm going to call it maybe a bear market in my definition, whereas those who define it by, there are definitions. When there's X% blah, blah, it's a bear market. It's been a bear market for me since the all-time high, notwithstanding squeezes and the rest of it, you know. And I trade both sides, you know. So when we had the uptrend, you know, until the bond auction, I was just well, I wasn't trading just longs, but primarily rotational trading, and I can change around depending on what's going on. Now, what am I looking for? I'm looking for excess, and my next trade might be under here and its reversion back here. How do I know which one of these is the right one? You see, that's why I'm not taking shorts up here, because if I took this, it'd be a stop. If I took that, it would be a stop. Do you see why I don't take the trade? Now, this is potential support, but I'm in a downtrend. So now I know where the sellers are here, and my buyers were there, and they got taken out. So this is now resistance. So I'm going to look at this and look at the order flow. I'm going to put a little box around this thing. And I have this to look at also. So I have this here, and I have this. Let's look. And this would be structured triggers. It's not a trade recommendation. Let's look. Remember what I said. I said, I'm not doing anything until I get back down in here. I could, if I was aggressive, I could take this, but I wanted to break back inside. So it hasn't done it yet. See where we came? So what do I suspect? IB continuation buyers. This is a structured trade in TraderLab, not qualified in my world. Other traders might take this. Where are the stops? Under here, under these swings, right down. You got to look left. Where do retail traders put their stops? This right here is support. Sellers were here. Absorption is there. Up. Absorption is here. These buyers. Up. Sellers are here. Where are the buyers? Here. So what do I have? Resistance. Resistance. This. Potential short. Not a recommendation. Very aggressive. Looking to take these guys out and these guys out. I have to get under here where I have absorption, and I'm looking to come here. It's not a trade recommendation. I'm just sharing that with you. By the way, I'm out of time. Use the link in the bottom of YouTube if you're interested in visiting TraderLab. There's no cost. Download the 60 PDFs of structured trades. You have to vet all of them. It's not plug and play. If you do plug and play, hasta la vista, thanks for playing. You have to vet everything. Use the link in the bottom of YouTube. Visit TraderLab. Also, please leave a like. It supports the stream and the TraderLab community. If you're waking up with Trader Groundhog Day, you might want to consider visiting the lab. Also, if you're not reaching the objectives you have, give it a thought this weekend and maybe determine if you're trading without an edge, if you want to change that. And of course, past performance is never indicative of future results. You know the story. And remember, there will be no stream on Monday due to the Memorial Day holiday in the U.S. Thanks, everyone, for visiting TraderLab. Don't forget the like, and I look forward to seeing you next Tuesday. Remember, there's a holiday on Monday. There will be no stream. Ponder over the weekend where you are and where you want to go. If you're experiencing Trader Groundhog Day, give it a think and determine whether or not you might want to change that. And of course, past performance is never indicative of future results. My mic might have been muted. That's why I'm repeating this. Please leave a like.